Hello, my dear students. As a part of the revision of the each and every chapter in auditing paper, today let us go for the another area of discussion, which is audit risk. So very important for examination. Now we are doing the quick revision of each and every chapter and each and every part in auditing paper for the student benefit. So audit risk, so which is very easy to understand and very important for examination majority of the times. So these questions have been tested in the examination. Now let us take an example. Let us go for the a live example to understand this particular concept of audit risk. Now before explaining about the audit risk, we need to understand the financial statements of the company should be prepared by the management. Now who is responsible to prepare the financial statements? So always we say management is responsible to prepare the financial statements of the companies. Now these financial statements should be issued to the auditor in order to audit the financial statements. Now when the financial statements are issued to auditor is going to examine these financial statements using various audit procedures. Now listen very carefully, there is the matter. Now management is going to prepare the financial statements of the companies as per the accounting standards and as per the schedule number 3 of the Companies Act 2013. Now what auditor has to do? Auditor has to apply various audit procedures which is given in the standards auditing in order to efficiently and effectively conduct the audit. Now listen my dear friends, financial statements to be prepared by the management. Now in order to prepare the financial statements in a true and fair manner, the management is going to introduce always internal controls to the organization. So internal controls. There are some of the companies which have been already introduced the controls and not introduced the controls. So internal controls are DIM. What is DIM? Designed by the management and implemented by the management and monitored by the management. Now these financial statements, there is always a possibility that financial statements may be misstated because of lack of controls. Financial statements may be misstated because even though controls are installed but not effectively working. At the same time, the financial statements may be having the misstatement which auditor has failed to identify those misstatements. Now entire the risk of audit risk will be run through the following example. Now let us go for the main concept of audit risk. Now audit risk means the risk the auditor gives inappropriate opinion on the financial statements. Listen very carefully my dear friends. The language is given inappropriate audit opinion when the financial statements are materially misstated. What it means? When the financial statements are having errors and frauds, auditor says there is no errors and frauds. So when the financial statements are materially misstated, auditor is supposed to tell that financial statements are materially misstated. But in the given case, the financial statements are materially misstated. That means financial statements are having errors and frauds, but the auditor says there is no errors and frauds. That means he is giving inappropriate opinion instead of the proper opinion. Now the risk means the auditor, the auditor of the company gives inappropriate opinion. That means not a proper opinion. When the financial statements are materially misstated. The audit risk is a function of risk of material misstatements and detection risk. Now the material misstatements are happened in the financial statements. Now who is responsible for the financial statements? Management is responsible for the financial statements. Now who is responsible for errors and frauds? Management is responsible for the errors and frauds. Who is responsible to introduce the internal controls? Management responsible to introduce the internal controls. Now who is responsible to detect the errors and frauds during the course of the audit? auditor is held responsible to identify the misstatements in the financial statements using his skill and care during the course of the audit. Now what happened in this particular statement, my dear friends, we are doing quick revision of the concepts. Now listen very carefully. It's very clearly says auditor is giving inappropriate opinion when the financial statements are materially misstated. Now let us take another example. Financial statements are reflecting true and fair view, but auditor says it is not true and fair view. It is not true and fair view. Is this a audit risk? Means it is not a audit risk. What is audit risk? Financial statements are having material misstatements, but auditor says there is no material misstatements. This leads to audit risk. Not vice versa. Not vice versa. Example, auditor issued unmodified opinion. What is unmodified opinion? Unqualified opinion. That means there is no remarks in the financial statements. Clean report auditor is given on the audited financial statements, even though financial statements are materially misstated. Now we are going to see what is material misstatement also in the particular concept. Now he is supposed to give the modified report, but he is not given, which leads to the audit risk, because auditor should give the modified opinion, but auditor is not given the modified opinion because he has given the inappropriate opinion. Now the audit risk formula, very important for examination. Now who is responsible for the audit risk? Now audit risk contains the following components. What are the following components? Risk of material misstatements plus detection risk. Who has to detect the risk in the financial statements? Auditor has to detect the risk in the financial statements. Now who is responsible for the risk of material misstatements? Material misstatement happened because of the negligence of the management. Material misstatement happened in the financial statement because of the errors happened in the financial statements. Material misstatement happened in the financial statement because of the fraudulent transactions in the financial statements. Now risk of material misstatement happened because of these two reasons. Risk of material misstatement is equal to inherent risk and control risk. Now audit formula is equal to audit risk is equal to inherent risk multiplied with control risk multiplied with detection risk. For inherent risk and control risk, who is responsible, my dear friends? Management is responsible. May be tested for the MCQ based questions. For detection risk, who is responsible? Auditor is responsible, because now let us see what is inherent risk, what is control risk, what is detection risk. Shall we proceed? Good. Now risk of material misstatement consists of how many components? Two components. What are two components? Inherent risk and control risk. Now what is inherent risk? What is inherent risk? There is always a risk, that means a problem, before considering internal controls. That means any risk happened before installing the internal controls in the organization, then it is called inherent risk. It is called as inherent risk. There is no controls at all, but risk is happened, then this is called as inherent risk of the entity. A particular transaction, that means profit and loss items, balance of an account, which means balance sheet items, or a disclosures required to be made in the financial statements of the entity have a chance of, what is the meaning of chance? Probability of being misstated, and such misstatements can be material. This risk is known as inherent risk. Now example, there is a financial sector, so inherent risk is always are going to be understood in the perspective of financial institutions or banks. Now what is going to happen in the banks, my dear friends? You might be seeing in the bank, the cashier might be collecting cash. Now is the risk involved or not? There is always a risk that cashier can run away with the cash, available cash in the bank, but it is not possible for the banker to tie that particular cashier, and he cannot control the cashier to go out. Maximum they can do a safety grill, and they can lock the room to protect from the outsiders, not from the cashier. Now cashier can commit a mistake, then there is always a possibility that in case of the financial institutions where loans have been given or chit fund companies where the chits have been taken, there is a collection boys who will collect the cash from the particular subscribers. Now there is always a possibility that the collection boys can go away with the particular cash, but it cannot be controlled. It cannot be controlled. Now this is called as inherent risk. Now one line summary of entire discussion. In case of inherent risk, before considering controls, risk has happened. Before considering controls, risk has happened. Now classical example is cashier of the bank, collection boys of the particular organizations. Now control risk. Control risk means internal controls are existed and operating in a company. Which means what? After introduction of the internal controls. After introduction of the internal controls, which are not be sufficient enough to stop from happening or find out and then rectify the appropriate time. Now, even though there is a controls in the organization, the transactions, balances and disclosures which are shown in the financial statements are having errors and or frauds. Errors and frauds. Why? Sir, management is introduced the control now, sir. Why it is still happening? Even though management is introducing controls, it may not be possible for every employee to exactly follow the control. There may be a possibility for collusion of employees. 2 or more employees may be coming together in order to commit a mistake. Poor design of controls. Control is existed, but it is not suitable for the organization. Weak inventory tracking in the business. You have kept one control for the inventory tracking, but the control is very, very weak. When there is a controls are weak, the people might be tempted to commit a fraud in the organization. Now, one line summary of entire discussion. Even though there is a internal controls existed in the company and organization, if misstatement happened, then we call it as a control risk. Now, who has to rectify this control risk? Management has to rectify this control risk. Who has to rectify the inherent risk? Management has to take measures to minimize the inherent risk. Now comes to detection risk. Now who has to detect? Auditor has to detect. Now, but auditor failed to detect the misstatement. Auditor is applying his audit procedures. Various audit procedures are available to auditor as per standard number SA 500, then 505, then 520. All these standards are talks about audit procedures. But still our auditor has failed to detect. Now, when auditor fails to detect such kind of misstatement, who is responsible for this? Auditor only responsible. Auditor is supposed to plan. Auditor is supposed to plan the audit procedures properly. Now, let us understand the meaning of detection risk. Detection risk is the risk that the procedures, what procedures? Audit procedures performed by auditor will not detect the misstatement. Financial statements are having errors and frauds, but auditor failed to identify these errors and frauds. Auditor failed to identify these errors and frauds. Now, that exists and that could be material. What is material? Significant amount which can influence the users is called material. The material can be either individual or when aggregated with the other misstatements. What is aggregated? So, individual transactions as individual transaction, that means something plus something plus something called as the aggregate amount. Example, individually 5,000 may be material, but aggregate you can say 1,000 rupees, 2,000 rupees, then comes to another 1,000 rupees, then another 500 rupees, another 500 rupees, even this comes to 5,000 rupees. Either individually or aggregate, if the misstatement happened in the business, but auditor failed to detect such misstatements, we call it as a detection risk. Now, what is risk here? Auditor failed to find out the misstatement is called a risk, for which auditor only responsible. Now, auditor may be using sampling as per standard number 530, but there is always a sampling risk. Auditor may not be applying the proper audit procedures, which is not because of the sample, because of the negligence of the part of the auditor. Then it may be non-sampling risk. Example, an auditor need to perform physical counting of inventory as per standard number 501 and compare the results of the accounting records as per standard number 520. What is 520? analytical procedures, that means comparison of the financial figures. Now this work is performed to prove the existence of inventory. If the auditor tests samples for inventory and count is insufficient to estimate or conclude on the entire inventory. Example, if I want to give a comment on 100% of inventory, the test of samples may not be sufficient. The detection risk is higher in this case, because when I am going on sample basis of verification, there is always a possibility that whatever the auditor is not verified, there may be a possibility for detection risk. So because auditor is failed to check that particular inventory, there may be possibility for higher risk in these particular transactions. Now, who is responsible for detection risk? Auditor is responsible for detection risk. Now comes to what is the formula for detection risk? Audit risk is equal to, what is the formula for audit risk? Audit risk is equal to inherent risk into control risk multiplied with detection risk. So please note that it is not having plus symbol, it is having multiplication symbol, because always risk will be multiplied, it is not in the addition. Now comes to the another area of explanation. Sir, how to assess this risk? Example, there may be different kinds of organizations. There may be a small organizations, medium organizations, then micro organizations, small, micro, medium and large organizations. Because in case of large organizations, large volume of transactions, there is always a high possibility of risk, high possibility for misstatements. Now the assessment of risk is a matter of professional judgment of auditor. What is the meaning of professional judgment of auditor? Professional judgment of auditor is nothing but qualification, that means he should be a qualified chartered accountant, skill and competence of the auditor, plus he is having past experience of such kind of organizations. Now all put together, what is the meaning of competence? Knowledge. So qualification of auditor plus skill and competence of auditor plus past experience of auditor is called as professional judgment, which may change from auditor to auditor. Sorry, auditor to auditor. Why auditor to auditor? Because every auditor may not have the same skills, every auditor may not be having the same experience. There may be junior chartered accountants, there may be senior chartered accountants. So based on their experience, they can assess the risk. Example, if a 50-year-old chartered accountant, if the moment he has seen the sector where he is having a very sound knowledge and sound experience, he can immediately say that you go to the March month and there may be possibility for wrong entries in the books of accounts. It is given based on the experience of the particular person. Now, how to set this materiality? As we told, it is based on professional judgment. Let us take an example. XYZ company taken a loan of 1 lakh from a bank based on the condition that current ratio should not fall below 1. Now, auditor can set a materiality level now, that means which is a significant level, where the current ratio falls below 1, it comes down less than 1, then he can say that financial statements are materially misstated. Now, why he has taken decision like this? It is based on the judgment of the auditor. Now, what is material misstatements? Misstatements including omissions are considered as material. What is material? Significant. If they individually, means either one transaction, or in aggregate, that means multiple transactions, could reasonably expected to influence economic decisions. What is the meaning of economic decisions? Financial decisions of users taken on the basis of the financial statement. That means any omission in the financial statements, which may be a single transaction. Example, 1 lakh rupee is the materiality level set by the auditor. How the auditor will set this 1 lakh? Based on his experience, based on his knowledge, based on his skill and competence. Now, during the course of the audit, auditor identified 1 lakh transaction which is omitted from recording, that is not recorded in the books of accounts at all. Now, what auditor can say now? Now, I identified 1 lakh rupees which is called as materially misstated. So, based on this, I am going to give the modified opinion on financial statements. Now, during the course of the audit, another example, auditor found out 250,000, 50,000 plus 50,000. Now also it comes to 1 lakh rupees because of the multiple transactions. 50,000 plus 50,000 is equal to 1 lakh, which is set by the auditor. In this case also, auditor is going to give the qualified opinion. Now come to the material misstatements. Maybe happen because of the fraud, material misstatement happen because of the errors, material misstatement because of the negligence, which may lead to the various kinds of risks. Now, another important area for the examination, audit risk versus materiality. Materiality means significant errors and frauds in the financial statements. Audit risk is nothing but auditor failed to identify the misstatements. Then there may be a possibility for misstatements in the financial statements from the management side also. Now, always the audit risk versus materiality having inverse relationship. What is inverse relationship? When audit risk and materiality levels, when audit risk is higher, materiality level is lower. When audit risk is lower, materiality level is higher, is called as inversion relationship. Now, the lower the materiality, the higher the audit risk. That means when auditor is set the materiality level to some 50 rupees, 100 rupees, 500 rupees like that, then he may not detect such kind of small transaction which is highly concealed by the particular employees. And in case of large volume of transactions, it may not be possible. Hence, if auditor sets high value of materiality level, example, auditor sets 1 lakh rupee as a materiality level. Now, there is always a possibility that any transaction which may not be recorded by the management, a 1 lakh rupee transaction, which can be easily identified by the auditor. Once auditor identify this kind of risk, then audit risk will come to the lower level, which can be reduced to the maximum level. Now, we can identify from this picture. Now, there is a materiality level is lower, audit risk is higher. When materiality level is lower, that means there is errors and frauds, small errors and frauds, which auditor may not be able to detect. When auditor may not be able to detect, it leads to higher of the audit risk. Now, with this, we are concluding this particular topic. So, I wish you all the best for your examinations, and I hope you understand the concept clearly. And if you are, so this is a little bit complicated concept in the subject. So, first read the example given, and then you can go for the understanding of the particular concept of audit risk. So, where we can expect the majority of the marks for the examination as well. So, thank you all for watching this video. So, good day.